Hey everyone, welcome back to Corporate Decoder. Today, W.E.B.S ETF Trust just filed its latest semi-annual shareholder report, and I am seeing some interesting trends across its various funds. Quick note, this is not financial advice, just my take on public filings for educational purposes. This report gives us a snapshot of how these specific ETFs performed over a 6-month period, and understanding these details can really help paint a picture of their strategy and risks. So what we're looking at here is a filing known as Form N-CSR. This is essentially a certified report that registered investment companies like W.E.B.S ETF Trust have to send to shareholders. It gives us the official rundown of their financial health, holdings, and performance for a specific period, which in this case is the 6 months ending the 30th of April. 2026. Let's dive into some of the specific funds within this trust. We'll start with the W.E.B.S SPI Defined Volatility ETF, or DVSP for short. This fund aims to track something called the Syntax Defined Volatility US Large Cap 500 Index. It is essentially trying to mirror the performance of a specific segment of the market, while also focusing on managing volatility. Now, everyone wants to know about costs for a hypothetical $10,000 investment in the W.E.B.S SPI Defined Volatility ETF. The cost for this period was about $42. That is 0.85% of the investment. This covers things like management fees and other operational expenses. It is important to remember this percentage is annualized, so for a shorter period, the actual dollar amount is less than what you'd pay over a full year. Looking at the key stats for DVSP, the total net assets were around $1.6 million. This means the total value of all the investments held by this fund, minus any liabilities, was about $1.6 million. The fund held only 3 portfolio holdings, which suggests a very concentrated strategy. The portfolio turnover rate was a very low 0.0%, meaning they weren't buying or selling a lot of assets during this period. Advisory fees paid were nearly $10,000. When we look at the top holdings for DVSP, the biggest one is a time deposit with JPMorgan Chase maturing on May 1, 2026, valued at a hefty 58.1% of the fund's net assets. This is a huge chunk of money parked in a single short-term investment. Following that, they hold the State Street SPDR S&P 500 ETF Trust at 48.6%, and then a total return swap on that same SPDR ETF, which actually has a negative value of minus 6.6%. This mix of a large time deposit, an ETF, and a swap is quite a specific strategy. Breaking down the security types, we see that 48.6% of the assets are in exchange, traded funds. These are basically baskets of stocks that trade like stocks themselves. Then a massive 58.1% is in time deposits, which are essentially very safe, short-term investments. Total return swaps make up minus 6.6% of the assets. And other assets less liabilities account for a tiny minus 0.1%. Next up is the W.E.B.S QQ Defined Volatility ETF, or DVQ. This fund is tied to the Syntax Defined Volatility QQS Index, meaning it is focused on the performance of major technology and internet companies, similar to the Nasdaq -100. For DVQQ, the costs for a hypothetical $10,000 investment are very similar to DVSP, also around $42 or 0.85% of the investment. DVQP has higher total net assets than DVSP, sitting at about $2.8 million. It holds 3 portfolio holdings and shows a portfolio turnover rate of 14.7%. Advisory fees paid were about $16,000. For DVQQ, the top holding is a time deposit with Citibank New York, also maturing on May 1, 2026, representing 53.8% of net assets. This is followed by the Invesco QQ Trust Series 1 ETF at 49.4% and a total return swap on the Invesco QQ Trust, which has a negative value of minus 3.1%. Again, we see that dominant time deposit positioned. The asset breakdown for DVQ shows 49.4% in exchange, traded funds 53.8% in time deposits, and minus 3.1% in total return swaps. There is also a small minus 0.1% in other assets less liabilities. Now let's look at the W.E.B.S Energy XLE Defined Volatility ETF, ticker DVX. This fund focuses on the energy sector following the Syntax Defined Volatility XL Index. Investment costs for DVXA are slightly higher at $54 for a $10,000 investment, or 0.86% of the investment. The total net assets for DVXI are about $1.3 million. It holds 3 portfolio holdings, and the portfolio turnover rate is 0.0%. Advisory fees paid were relatively low at just over $2,000. For DVXA, the top holding is another time deposit, this time with Citibank New York at 51.1% of net assets. Then we have the State Street Energy Select Sector SPDR ETF at 44.0% and a small positive position of 6.8% in a total return swap on that energy ETF. The most notable thing here is that the time deposit is the largest asset. Securities for DVXE are broken down as 44.0% in exchange, traded funds 51.1% in time deposits, and 6.8% in total return swaps. There is a negative holding of -1.9% in other assets less liabilities. Next is the WEBS Materials XLB Defined Volatility ETF, known as DVXB. This fund tracks the Syntax-defined Volatility XLB index, focusing on companies in the materials sector. The costs for DVXB are $51 for a $10,000 investment, or 0.87% of the investment. DVXB has significantly lower total net assets, just over $288,000. It has 3 holdings and a 0.0% portfolio turnover rate. Advisory fees paid were around $1,100. The top holding for DVXB is the State Street Materials Select Sector SPDR ETF at 48.9%. Following that is a time deposit with Citibank New York at 41.6% and then a total return swap related to the State Street Materials ETF at 10.9%. Here, the ETF is the largest component, followed closely by the time deposit. Security type breakdown shows 48.9% in exchange, traded funds 41.6% in time deposits, and 10.9% in total return swaps. Trees a -1.4% from other assets less liabilities. We're moving on to the WEBS Industrials XLI Defined Volatility ETF, or DEVIN. This fund focuses on the industrial sector, following the Syntax-defined Volatility XLI index. DEVIN's costs come in at $45 for a $10,000 investment, or 0.85% of the investment. Total net assets for DEVIN are about $295,000. It holds 3 positions with a 0.0% portfolio turnover rate. Advisory fees paid were about $1,165. For DAVIN, the largest holding is the State Street Industrial Select Sector SPDR ETF at 48.8%, then a time deposit with Citibank New York at 39.4% and a total return swap on the State Street Industrial ETF at 11.8%. Similar mix again with the ETF leading. DEVIN's asset breakdown is 48.8% in exchange, traded funds 39.4% in time deposits, and 11.8% in total return swaps. This adds up to over 100%, which is common when the swap position is significant. Now for the WEBS Consumer Discretionary XLI Defined Volatility ETF, ticker DVXI. This fund targets the consumer discretionary sector following the Syntax-defined Volatility XLI index. DVXE has costs of $40 for a $10,000 investment, which is 0.86% of the investment. DVXY's total net assets are around $236,000. It has 3 holdings with a 0.0% portfolio turnover rate. Advisory fees paid were about $1,043. Top holdings for DVXI include the State Street Consumer Discretionary Select Sector SPDR ETF at 56.1%, then a time deposit with JPM Chase at 50.8%, and finally a total return swap on the State Street Consumer Discretionary ETF with a negative value of -5.7%. This fund has a substantial ETF holding. Looking at DVXV's security types, 56.1% is in exchange, traded funds 50.8% in time deposits, and -5.7% in total return swaps. There is also a -1.2% from other assets less liabilities. Moving to the WEBS Consumer Staples XLP Defined Volatility ETF, or DVXP. This fund follows the Syntax-defined Volatility XLP index, focusing on companies in the consumer staples sector. For DVXP, the cost for a $10,000 investment is $46, or 0.85% of the investment. DVXP has total net assets of about $255,000. It lists 4 portfolio holdings with a 0.0% portfolio turnover rate. Advisory fees were about $1,024. The top holding for DVXP is the State Street Consumer Staples Select Sector SPDR ETF at 50.8%, then a time deposit with Citibank New York at 39.5%, another time deposit with JPMorgan Chase at 6.9%, and a small total return swap at 2.8%. This fund has a split between ETF and time deposits. DVXP's security breakdown is 50.8% exchange, traded funds 46.4% time deposits, and 2.8% total return swaps. This adds up to just over 100%. We're now at the WEBS Healthcare XLV Defined Volatility ETF, or DVXV. This fund tracks the syntax-defined volatility XLV index, focusing on the healthcare sector. The cost for DVXV is $43 for a $10,000 investment, or 0.85% of the investment. DVXV has total net assets of about $576,000. It holds 3 positions with a 0.0% portfolio turnover rate. Advisory fees paid were around $3,366. The largest holding for DVXV is the State Street Healthcare Select Sector SPDR ETF at 48.2%. This is followed by a time deposit with Citibank New York at 44.3% and a total return swap on the healthcare ETF at 7.6%. The ETF is the dominant position here. DVXV's asset breakdown is 48.2% in exchange, traded funds 44.3% in time deposits, and 7.6% in total return swaps. It also has a small minus 0.1% from other assets less liabilities. Next is the WEBS Financial XLF Defined Volatility ETF, or DVXF. This fund focuses on the financial sector, tracking the syntax-defined volatility XLF index. DVXF's costs are $42 for a $10,000 investment, or 0.85% of the investment. The total net assets for DVXF are around $238,000. It holds 3 positions with a 0.0% portfolio turnover rate. Advisory fees paid were about $1,021. DVXF's top holding is the State Street Financial Select Sector SPDR ETF at 51.9%. Next is a time deposit with Citibank New York at 48.5% and a very small negative value of minus 0.3% for a total return swap. The ETF and time deposit are nearly equal in weight. For DVXF, 51.9% is in exchange. Traded funds 48.5% in time deposits and minus 0.3% in total return swaps. There is also a minus 0.1% from other assets less liabilities. We're looking at the WEBS Technology XLK Defined Volatility ETF DVXK. This fund tracks the syntax defined volatility XLK index, focusing on the technology sector. DVXK has costs of $42 for a $10,000 investment, or 0.85% of the investment. DVXK's total net assets are about $303,000. It holds 3 positions with a 0.0% portfolio turnover rate. Advisory fees paid were around $1,189. The largest holding for DVXK is the State Street Technology Select Sector SPDR ETF at 48.6%. This is followed by a time deposit with Citibank New York at 41.3% and a total return swap on the technology ETF at 10.2%. This structure shows a strong ETF position balanced with a time deposit. DVXK's assets are divided into 48.6% exchange, traded funds, 41.3% time deposits, and 10.2% total return swaps. Other assets less liabilities are at minus 0.1%. Next is the WEBS Communication Services XLC Defined Volatility ETF DVXC. This fund focuses on the communication services sector, following the syntax-defined volatility XLC index. DVXC has costs of $42 for a $10,000 investment, or 0.85% of the investment. DVXC has total net assets of about $272,000. It lists 4 holdings, with a 0.0% portfolio turnover rate. Advisory fees paid were around $1,162. The top holding for DVXC is the State Street Communication Services Select Sector SPDR ETF at 49.6%. This is followed by time deposits with Citibank New York at 34.3%, JPMorgan Chase at 7.3%, and a total return swap on the State Street Communication Services ETF at 8.9%. This shows a diversified approach within its holdings. DVXC's security breakdown is 49.6% exchange, traded funds, 41.6% time deposits, 8.9% total return swaps, and minus 0.1% from other assets less liabilities. We now look at the WEBS Utilities XLU Defined Volatility ETF, or DVUT. This fund targets the utility sector following the syntax-defined volatility XLU index. DVUT's costs are $43 for a $10,000 investment, or 0.85% of the investment. DVUT's total net assets are about $288,000. It holds 3 positions with a 0.0% portfolio turnover rate. Advisory fees paid were about $1,136. For DVUT, the top holding is the State Street Utilities Select Sector SPDR ETF at 48.4%. This is followed by a time deposit with JPM Chase at 42.2% and a total return return swap on the State Street Utilities ETF at 8.9%. This structure seems to balance the ETF with a time deposit. DVSP's asset breakdown is 48.4% exchange, traded funds, 42.2% time deposits, and 8.9% total return swaps. Other assets less liabilities are at 0.5%. Finally, we have the WEBS Real Estate XLRE Defined Volatility ETF, known as DVRE. This fund focuses on the real estate sector, tracking the syntax-defined Volatility XLRE index. DVRE has costs of $44 for a $10,000 investment, or 0.85% of the investment. DVRE's total net assets are around $246,000. It holds 3 positions with a 0.0% portfolio turnover rate. Advisory fees paid were approximately $974. The largest holding for DVRE is the State Street Real Estate Select Sector SPDR ETF at 53.0%. This is followed by a time deposit with JPM Chase at 41.4% and a total return swap on the State Street Real Estate ETF at 5.7%. The ETF is the dominant position here. DVRE security types are 53.0% exchange, traded funds 41.4% time deposits, and 5.7% total return swaps. Other assets less liabilities are at minus 0.1%. Now let's dive into the financial state of these funds. The schedule of investments gives us a detailed look at where the money is actually going. For the WEBS SPY Defined Volatility ETF, we see almost 49% in the State Street SPDR S&P 500 ETF Trust, valued at over $798,000. A huge portion, over 58%. Is in time deposits from JPM Case, totaling about $954,000. This means a large amount of cash is held in relatively low yield, though safe, deposits. This is a consistent theme across many of these funds. The statements of assets and liabilities provide a balance sheet for each fund. For WEBS SPY Defined Volatility ETF, net assets are just over $1.6 million. Interestingly, there is an unrealized appreciation on a swap agreement of nearly $109,000. This reflects a loss on a derivative contract that hasn't been closed out yet. Let's look at the QQ ETF. Its net assets are around $2.8 million. It holds about 49% in the Invesco QQ Trust and a large 53.8% in a time deposit with Citibank, valued at over $1.5 million. Similar to the SPY ETF, a significant portion is in these short-term deposits. For the Energy ETF, total net assets are about $1.3 million. It has substantial holdings in the State Street Energy Select Sector SPDR ETF at 44% and a time deposit at 51.1%. It also has a positive unrealized appreciation on its swap agreement, showing a gain of over $94,000. The Materials ETF, DVSP, has net assets of around $288,000. Its largest holding is the State Street Materials Select Sector SPDR ETF at just under 49%, followed by a time deposit at 41.6%. It also shows an unrealized appreciation on its swap agreement, adding about $31,000 in value. Moving to the Industrials ETF Devon with net assets of about $295,000. It holds the State Street Industrial Select Sector SPDR ETF at 48.8% and a time deposit at 39.4%. The fund also reports an unrealized appreciation on its swap agreement, valued at over $34,000. For the Consumer Discretionary ETF DVXI, net assets are around $236,000. It has a significant weighting in the State Street Consumer Discretionary Select Sector SPDR ETF at 56.1% and a time deposit at 50.8%. However, it has an unrealized depreciation on its swap of over $13,000, indicating a loss on that derivative. The Consumer Staples ETF DVXP has net assets of about $255,000. It holds the State Street Consumer Staples Select Sector SPDR ETF at 50.8%, with time deposits making up about 46.4%. It also shows a positive unrealized appreciation on its swap agreement, valued at over $7,000. For the Healthcare ETF DVXV, net assets are around $576,000. The largest holding is the State Street Healthcare Select Sector SPDR ETF at 48.2%, with time deposits at 44.3%. The fund reports a substantial unrealized appreciation on its swap agreement, adding nearly $44,000 in value. The Financial ETF DVXF has net assets of about $238,000. It holds the State Street Financial Select Sector SPDR ETF at 51.9% and a time deposit at 48.5%. This fund shows an unrealized depreciation on its swap agreement, resulting in a small loss of about $779. Looking at the technology ETF, DVXK net assets are around $303,000. It holds the State Street Technology Select Sector SPDR ETF at 48.6% and a time deposit at 41.3%. The fund also has an unrealized appreciation on its swap agreement, adding over $30,000. For the Communication Services ETF DVXC, net assets are about $272,000. It holds the State Street Communication Services Select Sector SPDR ETF at 49.6%, with time deposits around 41.6%. The fund reports a significant unrealized appreciation on its swap agreement, valued at over $24,000. The Utilities ETF DVUT has net assets of roughly $288,000. It holds the State Street Utilities Select Sector SPDR ETF at 48.4% and a time deposit at 42.2%. It shows a positive unrealized appreciation on its swap agreement, valued at over $25,000. Finally, for real estate, DVRE net assets are about $246,000. The largest holding is the State Street Real Estate Sector SPDR ETF at 53.0%, followed by a time deposit at 41.4%. The fund also has an unrealized appreciation on its swap agreement, valued at over $14,000. The statements of operations show the income and expenses for each fund. For the WEBS defined Volatility ETF, total investment income was about $26,000, while expenses were just under $10,000, resulting in net investment income of around $16,000. However, the fund saw a significant net realized and unrealized loss of over $308,000, leading to a decrease in net assets from operations. It is clear the swap agreements are having a large impact. The QQQ ETF had investment income of about $36,000 and expenses of about $16,000, giving it a net investment income of over $20,000. But similar to the SPY fund, it experienced a larger net realized and unrealized loss of over $185,000, resulting in a decrease in net assets. This really highlights the volatility associated with these types of structures. For the energy ETF, investment income was about $6,000 with expenses around $2,300. This yielded a net investment income of over $3,700. However, it faced a large net realized loss on swaps, and while it had unrealized appreciation on investments, the overall result was an increase in net assets of just over $10,000. The materials ETF saw investment income of about $3,000 against expenses of just over $1,100. This resulted in a net investment income of about $1,900. Despite a realized loss on swaps, a significant unrealized gain on swaps led to a substantial increase in net assets of over $73,000. The Industrials ETF had a net investment income of about $1,500 against expenses of $1,100. Despite a realized loss on swaps, a notable unrealized gain on swaps boosted its net assets by about $36,000. For the Consumer Discretionary ETF, net investment income was about $1,300 against expenses of just over $1,000. This fund experienced a net realized loss on swaps and a significant unrealized loss on swaps, leading to a decrease in net assets of about $27,000. The Consumer Staples ETF generated about $2,500 in net investment income with expenses of $1,000. It had a realized loss on swaps, but a substantial unrealized gain on swaps helped increase its net assets by over $36,000. The Healthcare ETF had a net investment income of about $5,000 against expenses of $3,400. It also registered a net realized loss on swaps, but a significant unrealized gain on swaps resulted in an increase in net assets of over $17,000. For the Financial ETF, net investment income was about $1,800 against expenses of $1,000. This fund saw a net realized loss on swaps and a slight unrealized loss on swaps, leading to a decrease in net assets of about $4,200. The Technology ETF had a net investment income of about $1,200 against expenses of $1,200. It experienced a net realized loss on swaps, and while it had an unrealized gain on swaps, it also had an unrealized loss on its underlying investments, resulting in a net decrease in assets of about $4,300. The Communication Services ETF saw a net investment income of about $1,500 against expenses of $1,200. It had a net realized loss on swaps, but a substantial unrealized gain on swaps helped increase its net assets by over $16,000. For the Utilities ETF, net investment income was about $2,600 against expenses of $1,100. This fund had a net realized loss on swaps, but a significant unrealized gain on swaps led to an increase in net assets of over $16,000. Finally, the real estate ETF had net investment income of about $2,800 against expenses of $1,000. It experienced a net realized loss on swaps and a net unrealized gain on swaps, resulting in an overall increase in net assets of about $21,000. Now let's touch on the financial highlights. This section often gives us quick performance metrics per S-hair. For the WEBS defined volatility ETF, the net asset value per S-hair started at $27.53 and ended at $27.39. The total return for this period was negative 0.24%. This is a big reminder that while these funds aim for certain strategies, actual returns can vary, and sometimes they go down. The expense ratio here is 0.85%, which is consistent across many of these funds. Looking at the QQ-defined volatility ETF, its net asset value total return was negative 0.33% for the period. The SPDR S&P 500 ETF Trust, which the DVSP fund tracks, had a net asset value total return of negative 0.24%. The divergence suggests the fund's strategy, including its swap positions, impacted its performance relative to the underlying ETF. For the QQQ fund, the market price total return was negative 0.44%. When the market price return is different from the net asset value return, it indicates how the market is valuing the ETF shares compared to the underlying assets. The notes to financial statements are where the really technical stuff lives, but they are crucial for understanding the full picture. Note 1 tells us W.E.B.S ETF Trust organizes multiple series, and these particular funds are non-diversified, meaning they can invest a significant portion of their assets in a small number of holdings. This can amplify both gains and losses. Note 2 details the accounting policies. A key point here is how investments are valued. They use fair value, which is pretty standard, but it also highlights that when market prices aren't readily available, they use estimates, and these estimates could differ from what the assets are actually worth. They also classify assets into level 1, 2, and 3 based on how easy it is to get market prices. Most of these funds have assets in level 1 or level 2, meaning they are mostly based on readily available market data, although time deposits are noted as level 2. Note 2 also goes deep into derivatives risk, explaining that using things like swap agreements comes with risks. There is the risk the other party won't pay up, the risk of inaccurate pricing, and the risk that the derivative won't perfectly track its target. They also mention that these derivative prices are volatile. This is a critical point for understanding the performance of these funds, which heavily rely on these contracts. For the WEBS defined volatility ETF, the report shows a liability of nearly $109,000 related to swap agreements. This means the fund owes money on these derivatives as of the 30th of April. 2026, the counterparty for this is Clear Street LLC. The QQQ ETF also has a significant derivative liability, close to $89,000, owed to Clear Street LLC on its swap agreements. In contrast, the Energy ETF has an asset of over $94,000 related to its swap agreements with Wells Fargo, meaning it is owed that amount. This difference between asset and liability positions shows how these strategies can lead to different outcomes depending on market movements. The Materials ETF shows an asset of about $31,000 from its swap agreement with Clear Street LLC. The Industrials ETF has an asset of over $34,000 from its swap agreement with Cantor Fitzgerald. The Consumer Discretionary ETF reports a liability of about $13,500 related to its swap agreement with Clear Street LLC. The Consumer Staples ETF shows an asset of over $7,000 from its swap agreement with Cantor Fitzgerald. The Healthcare ETF has a substantial asset of nearly $44,000 from its swap agreement with Clear Street LLC. For the Financial ETF, there is a small liability of about $779 related to its swap agreement with Cantor Fitzgerald. The Technology ETF shows an asset of over $30,000 from its swap agreement with Wells Fargo. The Communication Services ETF reports an asset of over $24,000 from its swap agreement with Cantor Fitzgerald. And the Utilities ETF has an asset of over $25,000 from its swap agreement with Wells Fargo. Lastly, the Real Estate ETF has an asset of over $14,000 from its swap agreement with Wells Fargo. The report also gives us the average notional amount of these swap agreements. For the SPY-defined volatility ETF, this average was a massive $2.5 billion. For the QQ ETF, it is even higher at $2.9 billion. These numbers represent the total value of the underlying assets these swaps are tied to, which is far larger than the net assets of the funds themselves. This shows the significant leverage involved in these strategies. For the Energy F, it was around $700 million, materials around $300 million, industrials around $280 million, consumer discretionary around $200 million, consumer staples around $220 million, healthcare around $700 million. Financial around $320 million, technology around $240 million, communication services around $380 million, utilities around $310 million, and real estate around $270 million. The sheer scale of these notional amounts compared to the fund's net assets emphasizes the high leverage and the potential for amplified gains or losses. Digging into the accounting policies, Note 2 points out that these funds are not diversified. This means they can put a big chunk of their money into just a few companies or sectors. The report specifically states that each fund will concentrate in the securities of a particular industry or group of industries to the same extent as its underlying ETF. This concentration risk is a major factor to consider. If one of these concentrated sectors performs poorly, the entire fund can suffer significantly. The report also dives into the risks. The defined volatility strategy risk is particularly interesting. It explains that the fund might reduce its exposure to the underlying ETF when volatility is high and the market is trending down. This strategy aims to protect against losses during downturns, but it also means the fund might miss out on gains if the market quickly turns positive. Conversely, when volatility is low and the market is trending up, the fund might increase its exposure, which could lead to bigger losses if the market suddenly reverses. Now, a few things in this filing are marked not applicable. This is common for this type of report. For instance, items related to code of ethics, audit committee financial experts, principal accountant fees, and audit committees are generally only required in annual reports, not these semi-annual ones. Going back to the financial statements, the report includes detailed financial statements for each fund. We can see the statements of assets and liabilities for WEBS defined volatility, ETF showing net assets of $1,643,224. The cost of investments was recorded at $1,689,129, meaning the market value was higher than the cost for the overall portfolio before considering the negative swap value. The financial highlights provide a per share view. For the WEBS defined volatility ETF, the net asset value per S-Hair was $27.39 at the end of the period. The total return was negative 0.24%. This means if you invested $1,000 at the beginning of the period, your investment would be worth about $997.6 by the end. The expense ratio is 0.85%. For the WEBS QQ defined volatility ETF, the net asset value per S-Hair was $28.56. The total return was negative 0.33%. A $1,000 investment would have become about $996.7. The expense ratio is also 0.85%. Let's check the energy ETF net asset value per S-Hair was $39.72. The total return was a strong positive 52.04%. A $1,000 investment would have grown to about $1,520. This is a huge return, likely driven by the large unrealized appreciation on its swap agreement. The expense ratio here is noted as 0.86%. The materials ETF shows a net asset value per S-Hair of $28.87 with a positive total return of 34.21%. A $1,000 investment would have grown to around $1,342. The expense ratio is 0.87%. The industrials ETF has a net asset value per S-Hair of $29.54 and a positive total return of 14.09%. A $1,000 investment would be worth about $1,141. The expense ratio is 0.85%. For the consumer discretionary ETF, the net asset value per S-Hair was $23.61 with a negative total return of 10.40%. A $1,000 investment would have dropped to about $896. This is a significant loss, emphasizing the risks in this sector and strategy. The expense ratio is 0.86%. The consumer staples ETF shows a net asset value per S-Hair of $25.52 with a positive total return of 16.73%. A $1,000 investment would be worth about $1,167. The expense ratio is 0.85%. The healthcare ETF had a net asset value per S-Hair of $28.82 and a positive total return of 5.84%. A $1,000 investment would have grown to about $1,058. The expense ratio is 0.85%. For the financial ETF, the net asset value per S-Hair was $23.86 with a negative total return of 1.74%. A $1,000 investment would have become about $982. The expense ratio is 0.85%. The technology ETF has a net asset value per S-share of $30.33. Its total return was negative 1.19%. A $1,000 investment would be worth about $988. This fund also saw a negative return, showing the volatility within the tech sector and the impact of the fund's strategy. The expense ratio is 0.85%. The communication services ETF's net asset value per S-share was $27.28 with a negative total return of 1.63%. A $1,000 investment would have become about $983. The expense ratio is 0.85%. The utilities ETF shows a net asset value per S-share of $28.83 and a positive total return of 6.15%. A $1,000 investment would have grown to about $1,061. The expense ratio is 0.85%. Finally, the real estate ETF has a net asset value per S-share of $24.68 and a positive total return of 9.38%. A $1,000 investment would be worth about $1,094. The expense ratio is 0.85%. The note section is quite extensive, but two highlights are the concentration risk due to the non-diversified nature and the heavy reliance on derivatives. The report clearly states that each fund is non-diversified under the 1940 Act, meaning they can be more exposed to the performance of a few key holdings. This is amplified by their use of swap agreements, which, as noted, are not always regulated like traditional futures and carry counterparty risk. The summary of derivatives information shows that most funds are holding liabilities related to swap agreements, meaning they owe money on these contracts. Only the energy, materials, industrials, healthcare, technology, communication services, utilities, and real estate funds show assets, meaning they are owed money on their swap agreements as of the 30th of April, 2026. This highlights the mixed performance of these strategies, with some derivatives generating gains and others resulting in losses. When we look at the top line numbers for the SPY fund, the average notional amount for its swap agreements was a staggering $2.5 billion. This massive figure compared to the fund's net assets of just $1.6 million illustrates the high leverage being employed. This leverage is a double-edged sword. It can amplify gains, but it also magnifies losses, making these funds potentially very risky. Remember, this is for a fund with only about 3 holdings. For the QQ fund, the average notional amount for swaps reaches an even higher $2.9 billion. This immense scale of derivative exposure underscores the sophisticated and potentially volatile nature of this fund's strategy. It is essentially a leveraged bet on the QQQ index's performance, managed with a defined volatility overlay. The risk section really drives home the complex nature of these investments. It talks about defined volatility strategy risk, explaining how the fund tries to manage risk by adjusting its exposure based on market volatility. However, it warns that this can lead to underperformance in certain market conditions. It also mentions underlying ETF risk, meaning the fund's performance is heavily tied to the performance of the ETFs it holds. For example, the energy ETF's concentration in the energy sector means it is highly sensitive to fluctuations in oil and gas prices, and is subject to significant regulatory and environmental risks. The report details sector-specific risks for materials: industrials, consumer discretionary, consumer staples, healthcare, financial technology, communication services, utilities, and real estate sectors. Looking at the overall picture, these WEBS-defined volatility ETFs are complex. They heavily rely on time deposits for stability, which doesn't offer great returns, and then use swap agreements to achieve their target exposure and volatility management. The performance varies wildly across the funds, with some showing strong double-digit returns like the Energy ETF, while others, like the Consumer Discretionary and QQQ ETFs, show negative returns for the period. The enormous notional values of the swap agreements compared to the fund's net assets are a major red flag for potential volatility. The risk I am watching is how these strategies perform in sustained down markets for the underlying ETFs, especially given the leverage from the swaps and the concentrated nature of some of these funds. What I am actually looking for is a clearer demonstration of how profitable and consistent this defined volatility strategy is over longer periods and across different market cycles. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If you found this breakdown helpful, please like this video, subscribe for more, and join our Discord community linked in the description.